Hello, my name is John, and today I'll be giving my advice on some basic guidelines to follow when investing in a company. Now, it must be said that this is not information that's specific to this time, but just general guidelines that'll age pretty well regardless of what market we're in. And this is specifically for the stock market. It will have some light mentioning of other financial things, but it will mostly focus on the stock market. So to begin, what should you expect from the market? Well, investing is not a one way ticket to the moon, as some Wall Street bettors would say on the forums. Rather, it's a long term financial vehicle meant to bridge the gap between retirement and how much you actually earn. Now, it is difficult to predict the market with any certainty, with so many unknown factors in play in the short term. However, markets tend to increase in value. Now, they are prone to massive booms and dreadful busts. As such, your wealth may vary from time to time. But nevertheless, listen to these tips carefully, as they can save you from financial mistakes and give you a fighting chance of retiring at a reasonable age. So to begin, cover your current expenses. If you're gonna need the money that you're investing within like the next 5 years, you really shouldn't invest it as if you put too much money in the market, money that you need to say, I don't know, pay off a loan, mortgage, or just general living expenses. You may be forced to take a loss on a position you were keeping for the long term due to adverse market conditions, which is harmful to your accumulation of wealth. Thus, having enough capital to cover your costs is crucial to establishing a portfolio. Don't invest more than you can afford to lose because the market is anything but predictable in the short term. And if you lose that money, then you have to take into consideration how you will deal with that fiscally and emotionally. Next, don't get investor FOMO. Nowadays, if you go on the sites like Yahoo Finance or I don't know, Wall Street Journal or Wall Street Bets, you'll see people posting about certain companies post up massive gains in their share prices, or you'll see people hyping up a potential IPO regarding a specific tech company that promises to change the world in some way, shape, or form. And this may prompt you to invest in these companies on a whim without doing your proper due diligence. Now, this is a pretty common mistake among younger investors, people my age, who seek to make a quick buck off the momentum of the markets. But oftentimes, by the time you have seen a post that has gained like a lot of upvotes, or as they say, or popularity, it's already probably too late to invest into the company from a valuation standpoint. As such, if you were to add this position into your portfolio, you'd be exposing yourself to unnecessary risk because you'd be entering an overvalued position, which is probably going to go down sooner or later. For example, like when companies initially go public, you have like companies like Palantir, Teladoc, Robinhood, GameStop. Like, actually, I really do like a company named Palantir. I actually really like that company, but it shows that even like good companies are victim to overvaluations by investors. So to deal with it, just recognize your financial objectives. I mean, if you don't need all the money like right now, then there's no point in taking that type of risk. Temper your expectations from the market. Don't like think that every investment you have to make has to be incredible. Sometimes it's better to go for longer, more stable investments and do your due diligence. This is going to be a pretty common theme. Do your due diligence throughout the document, but please, like, actually research the company before you buy in. Don't buy in and then research the company. So yeah, that's don't get investor FOMO. Next, don't buy high, sell low. So if you have enough cash to cover all your expenses, then when adverse market conditions hit, don't sell it immediately, and because this will make building wealth actually hard. Assuming you did your due diligence and have invested into stable long-term positions, then stands to reason that you shouldn't sell your portfolio on a whim. After all, if you sell after you have lost money, then you're playing right into the buy high, sell low meme. Don't be a meme. Now, it's a different story if the company's operations have been permanently crippled by a major economic event like a recession. But if it's a major long term investment that has high potential for growth and increases in profitability, and you think that the valuation is underestimated by the market as a whole, then it would be worth retaining one stake in the company. Having the guts to hold on to a long term market position, regardless of market conditions, in companies with very solid financials, performance, low debt, strong cash flows, strong cash, all that stuff over the long term is one of the like major things that you have to keep in mind when building wealth. Likewise, it's also crucial to avoid buying when people are being over bullish on the markets. Well, what do I mean by that? I mean, let's take the shoe shiner example. I think everyone has heard of this before, but like during 1930s, let's say you have the roaring stock market, 1920s, and everyone is talking about certain asset classes. This applies to barbers, your shoe shiner, literally anyone with a bit of extra cash is investing in the markets. This is an indicator that the markets are overvalued as people are buying off of hype as opposed to fundamentals. In fact, a couple of years ago, back when like Bitcoin was like $20,000, someone I knew, like some old grandma, talked about how they bought their first Bitcoin. And at that moment, I knew to stay the hell away from Bitcoin because I knew that person had no idea what they were talking about. And when people that have no idea what they're talking about start hyping up in a certain investment, that's a dead giveaway that that investment's probably overvalued. So, like Buffett says, be greedy when others are fearful and fearful when others are greedy. It's a pretty good way to actually build value in your portfolio. Next, do your due diligence. This ties back to the second point, but actually, don't buy companies because some over-optimistic 20-year-old gave unrealistic stock guidance for a specific company. These are your hard-earned dollars you're putting on the line, unless you want to feel like a Wall Street bets degenerate who lost his life savings on a rug pull or pump and dump scheme. You should research the fundamentals of the company before going full diamond hands in an investment, aka like hold for the long term. Because if you don't, you could experience a total wipeout of your holdings, especially in today's market where overvalued companies are everywhere. Also, when you do your research online, remember that individuals are being overly bullish or bearish on a company may very well have some financial incentive on part of the author to stretch the truth and warp the narrative to fit their agenda. So always cross-reference your material and make sure that the material that you're getting is actually true. And even when you've invested in the company, try to keep up with the news of the company. Don't just forget about it entirely because certain market conditions can lead to I guess, permanent crippling of the business's operations. And as such, you don't want to invest in a dead company because of that. This is important because it allows you to avoid investing into overvalued or poor performing companies. Um, Also, when markets are like how they are right now, we have like we're gonna enter a bear market, at least that's my view, but it allows you to like not be so fearful of how your investments are going to perform if you know how they work fundamentally. It also helps plan out your financial finances like going forward, mainly because you can kind of estimate how they'll perform in relation to the market, and this will allow you to kind of plan for retirement a little. All right. Next, this is actually a pretty important one. It's don't anchor at the price you bought at when it's time to rebalance your portfolio. What do I mean? Well, basically, when investing for the long term, don't pay attention to the price that you paid to buy in at a company. When evaluating when to sell, because that is one of the major logical fallacies that kills portfolios, people anchor onto the price they bought an investment at. So when that investment falters for fundamental reasons like a decrease in projected profits or a major loss in sector dominance, which permanently hinders the company, they don't sell the shares in the company, but rather they wait, and they wait just hoping to make their money back, hoping to get back to the price they bought it at. Now, not paying attention to the ongoing problems with the company, despite the saying of buy and hold for dear life, sometimes you have to know when to sell, regardless of when you bought that thing. Useful tip. When evaluating whether you should sell a stock in a particular company, ask yourself, if I don't have any shares in this company, like nothing at all, would I put this money in the company right now? If the answer is no, then you should probably sell to prevent further loss. If yes, then hold. If you follow this strategy, I can almost guarantee you can prevent like at least a few dead weight investments, like the minus 80%, those types of investments. Because I have like one of those right now. I think it's like neogenomics or whatever. So I'm also a victim to this fallacy as well. Um, but anyways, basically just like keep up with the news that your company has, make sure that your investments are sound and that they don't have any underlying issues that could damage your wealth. And make sure that they're worth keeping in your portfolio. Like if they're not worth keeping in your portfolio, you know, you know what to do. Next, diversify your holdings. This is one of the most common ones. You know, Pretty obvious for any competent investor. But yeah, try not to go all in on a single investment. By diversifying your portfolio, you make any one downturn in the market less damaging to your wealth as a whole. This reduces the volatility of your holdings and increases your long-term portfolio value. It must be said though, diversification does require portfolio balancing, and not everyone has the time to, go read through all the articles and actually manually balance your portfolio. So if you want to diversify your holdings, you can invest in index funds or mutual funds to gain diversification if you don't have the time for that. And I understand, people are busy. It's completely fair. Um, it also wouldn't invest to hurt. It would also wouldn't hurt to invest in other asset classes, bonds, stocks, real estate. But I'll talk about like bonds, real estate. I'll talk about those more in another video. Next one, start investing when you're young. I mean, this one's also pretty obvious, but a lot of people don't internalize how important it actually is. I mean, the more time your money has to cook in the market, the less you have to put in order to achieve your financial objectives. Thanks to the market's tendency to always go up, which seems to be holding true for now. Also, when you're younger, you have more leeway with the performance of your investments. This allows you to take higher risk and, potentially make higher returns depending on how things go. But even if you do suffer a major loss, you can actually recover from it. Which, if you're like 45 or 55 and you're retiring in like 10, 20 years, you can't necessarily do the same types of deals. Otherwise, you risk putting your financial well being on the line and can't really do that. This works well with like dividends and stuff because compound interest. But yeah, for example, let's say you need $600,000 for retirement. And so let's say you retire at 65. That gives you about $24,000 per year, assuming you live to 90. Ignoring inflation, government benefits, etc. And let's take the annual, and let's say you have an annual rate of 6% compounded annually. This is actually like pretty modest in terms of what you'd get, but let's just say that for the example. And let's say you invest at the end of each year. How much would this actually help you? Well, if you start, let's take a base case and say from 25, you don't invest in the markets at all, no investments, nothing. Then you'd have to save $15,000 a year for 40 years to get $600,000 when you're 65. Now, a lot of people can't do that. You have living expenses, you have to pay off your student loan debt, you have to get a house, all that stuff. There's no way that you can. I want to say there's no way, but like there's some edge cases, but for a vast majority of the population, it's very difficult to actually do that. But let's say you actually invested at the rate that I said earlier, 6% compounded annually. Then you'd only need to put in $3,877 a year. That's a significant drop. And like let's say you start investing in 45, then you'd only need $16,350 a year, which it's a lot, but that's like it shows the power of compound interest. But if you wait just another 10 years, the amount you have to put in each year almost triples. That just shows that you really want to invest while you're younger. It's crucial to securing your financial well-being. So please don't waste money on like trivial things. Investing that money now will net far greater returns down the line. So just keep that in mind. Next, remember past performance doesn't guarantee future returns. Okay, this might seem obvious, but it has to be taken into account. Just because you've had like a star investment that's always done well, that does not necessarily mean that it'll always be the case. It's always important to periodically review your investments and ensure that they'll perform well going forward. Because times change, especially right now, and sometimes certain investments that were very attractive in the past aren't holding up so well. Netflix. Anyways, last one we have here. It's adhere to a long-term strategy. Well, what do I mean by that? Think of your investment goals and financial objectives and build a strategy around that. Whether it be simple index fund investing or dollar cost averaging into a few high potential stocks. Because no matter what, if you lose sight of your long-term goals in your investments, you may make some decisions which damage your financial conditions, like being overly risky, and overall negatively impact your progress towards your goals. So just keep in mind those when investing. Also, please, whenever you're thinking about your finances, remember that accidents happen. Things sometimes go wrong when you're in your workplace, and workplace accidents are far more common than you might expect. So, get some insurance, or at least get like, I'd say 3 months, 3 months so you can find another job and do that. How would you do this? Just save generously while you're at your job. Don't spend on trivial things, yada, yada, yada. Also, be risk averse when it comes to investing large portions of your net worth. It's okay to have some money in like speculative investments. That's totally fine. I'm fine with that. But when you're putting large portions of your fortune, or I want to say fortune, of your wealth in very risky assets, you're exposing yourself to more risk than you may be willing to actually take. So, those are so that's my presentation. This is like more generalized advice. This isn't specific to this investing environment. June 25th, 2022. Things are really crazy right now. I'll release a video of how to invest in this market soon. But this is like more generalized information that you can apply to most markets. So yeah, I'll see you later.